What is debt to ratio income? But first, happy Gasparilla if you're watching this video. Today is Gasparilla in Tampa. It's when the Pirates invade Tampa. They take the key from the mayor and all craziness breaks loose. Big parade. It's craziness. And what am I doing during Gasparilla? Doing a video. I'm doing a video for you because I have multiple people that had said, can you explain what debt to ratio is and this and that? So I'm kind of going to go over it with you, okay? But I'm also going to give you guys a little tidbit for all you hospitality people out there. So debt to income ratio, it's a simple formula. How much money do you make compared to how much debt you have? So for instance, let's just say you make $100,000 a year and you have, a car payment and you have a rent and you have this and that, and it comes out to 50,000, let's just say, easy math. So you have a 50-50, right? 50 income compared to 50 debt, right? So that's the ratio. So basically, banks are going to look for the ratio of the debt compared to the income. And different loans have different ratios. Now, they have changed over the life of our lifetime, right? And this is why it's always important to get with lenders, to talk to them and say, I need to get pre-approved, maybe not now, maybe in a year from now. I have debt. What debt do I need to be paid off? So my debt compared to income ratio is better, which means the less debt you have, the better ratio. They want to see more ratio of obviously income compared to debt. Simple, right? That's all it is the debt compared to the income. But, big but here, there's a lot of people that work, quote unquote, off the books, or they claim a lot of taxes, right? Or they don't claim income. And this is where people get crushed. And I'll do a separate video on it eventually. But imagine you don't claim that much because maybe you work on tips or whatever the case may be. And now you're going to go get pre-approved. And it's like, well, you have so much debt, you don't really have a lot of income. And this is what always happens. But I make all this, but no, it's because you're trying to save. Like, people think always about like, oh, I got to do my taxes this year. I'm going to do all this, blah, 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 because they're never thinking about real estate. They're never thinking about buying a house in the future. So they don't want to claim a lot of income. So what happens on those ratios? Your income's a lot less, but your debt is pretty high. But it's really not high compared to the actual income you make. But since you're not claiming it, your debt to ratio is off. And sometimes you don't get approved for a loan. Or if you do get approved, it's for a lot less than you really can afford. Because remember, what you can afford, let's say you can say, I can afford $3,000 a month. It doesn't matter what you think you can afford. It's what the bank sees that you can afford. Because remember, the bank's really the ones buying the house. So they want to see the actual debt to income ratio, not the debt to what you actually make, but you're not claiming ratio. So there's a lot of things you need to talk to lenders about, whether it's bank statement loans or savings or debt to ratio. This is why it's so important to watch my videos, because you can say, I never thought about that. Or, you know what, I'm in hospitality and I eventually want to buy a house. I might need to talk to a lender about this. Or I do have some debt out there. What debt should I have, paid off? And how much time frame do I need to pay it off before? See, that's why I do this. So again, back to the easy. Debt to income ratio is just the calculations of how much debt you have compared to how much income. And that's it. Simple, breezy. Now back to what's super important today. Gasparilla. Are you going to be there? I hope you guys have an amazing Gasparilla day. I will be working on my computer, writing more blogs for you. Have a happy Gasparilla day.